Welcome to the Get Wealth Podcast. My name is Brennan Wiersma. Please be sure to like and subscribe if you haven't already. Today I'm here with financial advisor Ryley Nelson. How's it going, man?
Doing well. Thanks for having me.
Yeah, no problem. Thanks for coming. Excited to ask you some questions. I guess we'll start off. How can I be a millionaire by the end of the week?
So that's going to be pretty tough in my line of work. Really, the number one thing that I tell people is don't expect anything to happen overnight.
Yeah.
That's really especially for me being young, like having that long-term growth mindset every day, trying to make sure that you're setting yourself up better down the road. That's what I do every day. That's what I help people with, and then hopefully, when we get down the road, then you're where you want to be.
Yeah, that seems like the biggest factor is time. When you're young, like if you start in your teenage years or when you're 20, you have all this time for money to grow in whatever account or investment you have. And when you see someone coming in, they're like 60 years old and they realize they don't want to work at Applebee's anymore, it probably is a little stressful on your end.
Yeah, I can tell you from personal experience that I've talked to people that are in their late 50s and they just haven't really gotten started yet. With much of anything, and they hear through work, they hear through their friends that this is what I'm doing, and then they get curious about it, and then they want to learn. But a lot of times, what happens is that the clock's starting to run out. They're already in the fourth quarter, and so once you get to that point, you're in a much more different situation, right? Because now pressure's on, and you really gotta make sure you're saving every last penny to be able to, especially if we're talking about retirement, have that retirement that you're really looking for. So time is your number one ally, like your best friend. The people that start saving, investing, thinking about their future when they're younger, those are the people that have the freedom to really do what they want to do when they get to 50, 55, 60. Those are the people that get to choose when they get to leave work instead of being forced to work until a certain age, really.
Yeah, that's the dream. So before we get into any of that in detail, let's start off just a little bit about yourself. So how did you get into finance or to becoming a financial advisor? Was that something that you always wanted to do from a young age, or when did that come into the picture?
Yeah, I wouldn't say it was like my dream job when I was, growing up in middle school or high school or really anything like that. I do have a couple of really close family friends that are work with the same company as me over at EdwardJones. And so I knew it was a thing. My parents had an account with EdwardJones. When I was growing up, they had a college savings account for me that helped pay for my first year of school. So I knew it existed. I knew it was a thing, but I really didn't, know much about it until I got into college, and I figured, I probably want to do something along the business track. So I started talking to people and looking at the different ways that you can go about doing it. And I really started getting interested in the stock market when I started looking at that, my freshman year of college. And I just thought it was really interesting that this one part of, the news, the world, the American stock market is so newsworthy. It's always getting talked about, and so I was really interested by that. Like, why is it so popular? Why is this a thing? And you start learning about all the different types of jobs that you can do and be involved in the stock market. You can be a day trader down on the exchange floor in New York. You can be a hedge fund manager working with millions, if not billions of dollars for some of the wealthiest corporations in the world, or you can be, someone more on the personal side and using that sort of bringing Wall Street to Main Street kind of personality. And that's what really started to interest me was, being able to do something where I can help other people, because I was really interested in this and I was learning a lot. And as I was learning more, I was realizing, wow, I would have never learned this information had I not looked into this when I was. And so that's when I started talking to more people, and no one really knew a lot about it. They knew it existed. They knew, oh yeah, you're supposed to save for retirement, you're supposed to invest and save your money, but no one really knew how or what that looked like or how to accomplish it. And so that's when I realized, hey, I I can build a good business for myself, and I can help other people, my friends, my family, the people they know, achieve these things at the same time. And if you can do that, if you can make a good living for yourself and help other people while you're doing it, that's one of the best jobs you could probably ask for.
Yeah,
So
checking a lot of the boxes there.
So yeah, that's when I really got interested in Jones, and went through. I did an internship with them in college to sort of get the feel of the company, and absolutely loved it. A lot of financial services companies are publicly traded, right? They're on the stock market. You can buy shares of them. Edward Jones isn't. You can't buy a share of stock for Edward Jones, and the reason for that is we're a partnership. So every financial advisor is a partner in the firm. So each one of us is basically a shareholder of the firm. And because of that, we're each, inherently wanting to see the company grow and succeed because we are the owners.
Whoa.
For all intents and purposes, like we are the profit center. Like the financial advisor is the only part of the company that actually brings money in. And we are really the people that make the company who it is. And so that's really, really interesting to me. And I think it's really powerful also because we have direct control of the future of our company, which is not something that in any industry is very common. Normally you're a small fish in a big pond.
Yeah.
And you don't really feel like you have any control, but it's really quite the, like, we're surveyed every week on how we'd like to see the company improve and change, and what we say actually carries weight. It actually matters. Like we've seen, especially over these last 9 months or so, we've asked for things to change from just a technological standpoint to help our clients. We've seen it happen. Like the firm makes it happen. The people at our home office make it happen because we're asking for it. Mm-hmm. And so there's a lot of support. Everyone wants you to succeed because we're all in it together.
Yeah. So as a financial advisor, are you just basically that's your office, and as far as what you do from there with getting clients and working with them is up to you, or is there a ladder? Do you answer to people? Is there kind of like a more of a typical office scenario? How does it look like on a weekly or monthly basis working?
Yeah, so just like industry as a whole, so a lot of financial advisors, they have like a branch manager in the office with them. That's how it normally works. That's really common. So there's a lot of financial advisors out there, and that's how most of them function. You've got an advisor and you've got a manager in the branch office. That's typically how it goes. So it's a small office, but it's got that office feel. You've got someone that's making sure you're doing the right things for your clients, and that's generally how it works. With Edward Jones, our model is quite different. So with Edward Jones, the financial advisor is in the office, and then oftentimes we have an assistant as well that helps us with our scheduling and making calls to clients and things like that, that helps us run the business. And then other than that, that's it. We do have a branch manager, but they're remote. So they work out of our home office. And they basically just monitor to make sure that the trades we're doing for our clients make sense, and that we're doing the best things for our clients and following all the laws and regulations and rules, because there's a lot of them. But it's not direct supervision. So, when I go into work every week, I have complete control over my schedule. It's up to me to find my own clients. Edward Jones doesn't give me a list and say, hey, these are the people you're working with this week. Have fun. It's totally up to me to meet people, to introduce myself, to do things like this to where I can get in front of more people and reach more of a greater audience. And that's how I run my day. Yeah,
it sounds good and bad because there's no ceiling, but there's also no floor. Like if you want to be the best financial advisor in the Northern Hemisphere, you can do that, and you can have that many clients or work with that many people, or you can just, eat Cheetos and sit on the couch all day.
Yeah, and that's like especially for right now, because a lot of people, there's not really a big purpose of going into work if you can't see your clients, right? And I've only met with a handful of people in person. Most of the things I've been doing have been over Zoom just because of, our current situation, right? Yeah. And so for a lot of advisors, they're just staying at home and working from home. And for me, I know that I can't do that because I wouldn't stay focused. I've got to go into the office. I've got to, when I'm doing work, I got to be at work. I got to make sure I separate the two, because you're right. There is no floor. Like you've gotta provide for yourself and find your own business. You're building your own business for all intents and purposes. But the flip side of that is there is no ceiling.
Yeah.
At our company, you can get as big as you want, have as many clients as you want, earn as much revenue as you want, and you're never going to be limited.
That's awesome.
And so that's a huge positive, and especially for starting in this career as a younger person. The average age of a financial advisor is over 50 in the United States.
Are you serious?
Yeah. And so.
And how old are you?
22.
Okay, so you're under it by
22.
28 years.
Yeah.
That's awesome.
But the average age is over 50, and there's a couple reasons for that. But really, one of the big issues for a lot of firms is they constantly have turnover because their advisors are only in the industry for about 10 years. They get in, they do it, they're there for 10 to 15 years, they retire.
Mm-hmm.
And that's typically how it works for a lot of places. But I have the opportunity to be doing this for really as long as I want to do it. It's not a physically demanding job. I mean, I could do this job till I'm unable to mentally do it, right? Really as long as you want to do it. And that's something that drives me as well, because I know that, hey, I can have this business 30, 40 years. I mean, that's a pretty unique thing that.
Yeah, it's hard to do.
No matter what you're doing, if you own your own business for 30 or 40 years, I mean, that's the dream.
Right.
That's success in a nutshell. You're providing for yourself. You've built a client base that loves you and supports you and knows you do good work. I mean, that's what it's all about. So.
Yeah, I don't know what the statistics are, but the small businesses fail for however much, and more times than not, it's harder to get one off the ground and have one for especially that long.
It is, yeah.
So with your job, would you say that part is the most difficult as far as getting the clients and building a business, or is it more in the details and working with the people? What do you find the most challenging, or is it something else?
Yeah, so it's really interesting because it's really almost like two jobs in one. You've got to be able to meet people to have them become clients, right? And so that's a huge part of my day, is just finding ways to reach out to people and introduce myself. And that is not easy, especially now where, a lot of times, people don't answer the phone if they don't recognize the number.
Yeah.
Right? I know I don't. So, I mean, it's hard to meet people that you don't know. It really is. But that's how, especially, being young, I don't have this huge network of past, coworkers and other people that are wealthy. So you've got to go out and meet people that have been saving money for a while. And that's definitely hard to do. The flip side of that is, once you've met them, then the actual job comes in, and you actually have to build a portfolio. You've got to build a financial plan, and that's not easy either. So really, it's like two different sides of the coin, and they're both challenging. Like you have to know, okay, what kind of investments fit this person and why? What kinds of things are they going to be comfortable with and why? And then also, okay, that's great. How do I get them into the office?
Mm-hmm.
How do I make them feel comfortable enough with me that they're willing to do a meeting with me and learn?
Yeah.
And so both of those things are very challenging, and it takes a lot of determination, and you really just have to not care about being told no. Like, you just have to turn that dial off. When I was first going around in early March, I was knocking on doors. We're not allowed to do that right now for obvious reasons as a company. But I'm doing that. You're going door to door, knocking, talking to people you've never met, people from all walks of life. And, that's why I really liked when I saw what you were doing, when you were going around knocking doors. Like, dude, I did the same thing. Like, that is so cool.
Yeah.
And it's not easy. Mm-hmm. Like, it's flat out not easy, especially when you're trying to, introduce someone to sell a product. Yeah. I mean, they've got to really want to talk to you, or else they're just gonna. I mean, some people would just yell at me through the door. not interested. Some people, I get people would tell me, yeah, I don't need the religion. I don't need the religion. And it's like, no, that's not what I'm doing.
You gotta not wear a suit, otherwise they're gonna think you're working for the Jehovah's.
Yeah, I mean it's hard. Like I heard so many funny things from people, and it's hard. It's just there's no other word for it than it's hard, and you have to be able to handle rejection and just not care, and that takes time. Like the first day I was out door knocking, I got home and I felt like crap. I mean, it was just the worst day ever.
Yeah.
But I woke up the next morning. I was like, okay, well, it's probably not going to go any worse.
Did you have any success? Like, did anybody talk to you the first day?
Yeah. Yeah.
And you got a client from them?
So in total, I only was door knocking for about a week in March because I moved back here to start the business in March. And obviously, Washington got hit with its first COVID case in mid-March. So I literally was door knocking for about a week. But just from that 1 week of door knocking, I gained 3 clients.
Nice.
Up to this point.
Yeah. People are like willing to, when you get told no a lot, but from my experience, when I was starting this, most people said, "Oh, that's never going to work. No one's going to want to sit and talk to you about how they made money. It's like that's their business."
Yeah.
But when you knock on, actually, the very first door I knocked on, there's a podcast with him, Greg Allen. It's episode 1. He was like, "Yeah, I'll talk to you. Come and sit down." And there's surprisingly good people out there. They are willing to have a conversation. And most people, I think, the biggest thing for them is getting past that, insecurity of not wanting to get told no and knocking on people's doors. Because from my experience, it worked. And 3 clients, that's a big number.
It's a big deal for only door knocking for a few days. In all honesty, and it's something to where you're exactly right. If you do it enough times, you're going to come across people that for whatever reason they're having a good day, they're willing to talk to you.
Yeah.
And that's a lot of times it's just what day did you catch somebody on? Are they sick? If they're sick, they're probably not. They could be the nicest guy ever. If they're sick, they're not going to talk to you at the door.
Yeah.
Right. Like so much of it is random. And that's why you just got to have the mindset that hey, it doesn't matter what they say. What matters is I'm going out and I'm putting in the effort.
Yeah.
I'm going around, I'm doing my job, I'm introducing myself to people, that's all I can do. And if you do the things that you can control, ultimately, you're going to have success no matter if you're a financial advisor or in any other walk of life.
Do you go for the larger houses like I do for this?
So when I first was making my plans to go out and door knock, I was trying to figure out, okay, who do I want to target? How do I want to, is there a way that I could maybe become more successful in the way that I do this or what? And really, because with my line of work, you have to hit so many doors. You have to meet so many people that it really didn't matter. I was going to need more than just the couple nicest neighborhoods around my office. And so I just split up, into chunks that I knew, okay, this week I'm hitting this chunk, this week I'm hitting this chunk. I've got a binder in my office that's still detailed out. I got like 25 different areas around my office that I can hit. And some are more wealthy, some are less. But really the point is just go around and talk to people because you never know who you're going to meet at that door. It might not even be the owner of the home. It could be a family member that's answering the door. It could be a friend. Both those things have happened to me. You never know who's behind the door. You never know who you're going to meet. And so you really don't want to say, I'm not going to go talk to those people because they have no money.
Yeah.
You don't know anything about them
Right.
until you get to know them.
So how do you cash your check from working with people? Is it based off their gains or is it just a monthly thing or how does that work?
So there's a couple of different ways that my clients can choose to work with me. So we give folks the options of they can pay commissions. That's sort of the standard bearer. It's been around for a long time. A lot of older folks are familiar with the word commissions. They know how it works. Okay, when I buy something, a little bit goes to the guy that made the trade, right? So that's one way. The other more common thing that's come into the industry lately is we get paid basically a percentage of the account that we manage. And that's become more popular. It's sort of the difference between getting paid like large amounts intermittently. Like that's sort of what commissions tend to be, like bigger amounts but not all the time. And then the fee is smaller amounts more consistently.
Okay.
And so that's really, as a client, you just have to decide what fits you better. Because there's some people that want to trade a bunch. And if you want to trade a bunch, do you really want to be, getting hit with those commissions all the time? Probably not. So if you're just in that fee basis where you can trade as much as you want, it doesn't really impact you because you got the same fee based on the assets that you have in the account. Maybe that makes more sense. But the flip side is also true. If you're someone that doesn't really want to trade, you just want to save your money, invest it, and let it sit there, maybe it makes sense to just pay a one-time commission up front and then let it grow.
Yeah.
So that's the nice thing too. We don't put people in a box. We let them decide, and we also educate them on, hey, if this is what you want to do, here's the math, here's the cost that makes the most sense. Because a lot of times people don't know.
Yeah.
It's not something that most people are super comfortable with. So you have to educate them and tell them, here's the costs, here's the benefits, and then you let them decide ultimately.
Yeah. It sounds like a reasonable way of doing it. I get this perspective, or with like work retirements, or you hire a brokerage or something. It seems like they're always sneaky with fees, and they're doing it, but they're taking so much, and it's almost like they're taking advantage of people that don't know or care to look into it enough. Mm-hmm. But that seems like a fairly straight up, honest way of doing business.
Yeah, and the absolute truth of it is that nothing comes free in this industry. Anything that's sold to you as free isn't really free. Whether you're paying a cost or someone else is paying the cost right now, someone's paying the cost. And it's just figuring out who that is and why they're paying the cost, and figuring out why am I not paying it? Why would this other company let me do free trades? Like, it takes a lot of research to know but it's marketing, right?
Yeah.
It helps drive business. But I'm really clear with my clients about the costs. For example, mutual funds, really popular way to invest for retirement, really common. And mutual funds have some fees in them that are otherwise hidden if you never told somebody, because they're never sent a check to pay it. It never visually comes out of their account, but it still exists.
Yeah.
And so just telling people that there is a fee on this, like, you should be aware of it. That's education. That's helping people understand what they own and why they own it. Well, why would I want to pay this hidden fee? What are the benefits of it? Well, this is why we use mutual funds, talking to people about that.
Yeah. So let's kind of get into the meat and potatoes. What is a mutual fund? Let's just start there. What is it, and why is it beneficial as opposed to the other options?
Yeah. So a mutual fund, for all intents and purposes, is a bundle of investments. You can have a mutual fund of stocks. You can have a mutual fund of bonds. You can have a mutual fund of any number of financial instruments, but the most common is stocks and bonds. And really, when you're looking at a mutual fund, the reason why you'd want that over buying individual stocks themselves is diversification and safety. For instance, if I go out and I buy a share of Apple today, well, there's a little bit of risk in that, because Apple's a private company. Apple could go bankrupt. Like, it's possible. It's not likely, but they could. If that were to happen, I would lose my investment, most likely. So there's some risk reward there. Yeah, I could make good money off a share of Apple, but also, like, that's a private company that could go bankrupt. So there's some risk involved. With a mutual fund, they're holding maybe hundreds of stocks, maybe 100, maybe 200 stocks. So what does that mean? Well, I probably have Apple in there. Maybe I've got Costco. Maybe I've got any number of things, right? Well, if one of those companies were to go bankrupt, yeah, I still lose a little bit of money, but I didn't lose the entire value of my account, right? Because I'm not just invested in one thing. I'm invested across hundreds of things. It's kind of like you've got all the ingredients that make the pie, right? You got the sugar, you got the flour, you got the pumpkin, right? So each one of those ingredients is like a stock, right? And then when you put it all together, you've got this pie, and I own one slice of that pie, everything all mixed together.
Yeah.
And so for young people, there's a big advantage. I myself own mutual funds for my own retirement account right now because I don't really have to worry about it. It's not something I have to look at on a day-to-day basis because I'm not worried whether it goes up or down in a given day because I know I've spread my risk out over hundreds of companies. And it's something that I know is going to just continue to grow for years and years. And I don't need to chase high returns from any particular company that I think might be doing well because I've got time on my side. Mm-hmm. So like I own mutual funds. I think they're great because it sort of just lets you build a good portfolio and let it be. It doesn't take a whole lot of, obviously you need to make sure that it's performing well, but it doesn't take a whole lot of worry on your part.
Maintenance or,
So when you're young and you got other things you're worried about, you're going to work, you're pretty busy, right? Going to school, like it's just something that lets you invest without having too much risk on the table.
And so do those fees come from an individual person building and managing that mutual fund for you? Because what would make that different than an index fund?
Yeah, so an index fund, also oftenly those are ETFs. They're very similar. So an ETF or an index fund tracks an index. So you've got the S&P 500, which is 500 of the largest U.S. companies, right? So there's index funds that own literally each of those 500 companies. And they track, if the S&P goes up 2% in a day, your index fund went up 2% for the day. A mutual fund doesn't have to stay in that box. They might have 400 of those 500 companies, but maybe they've got 100 others that are different. Or maybe they only own 100 stocks specifically.
Yeah.
And the mutual fund has a goal. Their goal might be to minimize risk. Their goal might be to maximize return. But they have a goal that they're trying to achieve with the companies they hold, whereas the index fund, its goal is just matching that index. Mm-hmm. So the index fund has fees, but they're very small because it doesn't take a whole lot of work to just, those are the 500 companies I need to buy them, sell them to someone.
Yeah.
Whereas the mutual fund, someone is actually trying to achieve something there.
Got it.
They're trying to manage it in a way to either get better returns or minimize the risk, or a combination of the two. And so for that reason, the fees on a mutual fund are generally higher. And so for most people, there's a reason to own both.
Yeah.
It's all about diversification and spreading out your risk and spreading out your costs. There's no reason why you wouldn't want to hold both. They're both beneficial in their own way. And I'll never be one to say that there's only one type of investment that's right for everyone. Yeah. It's just not true. There's some people that really are focused on paying the least amount in costs that they possibly can. And performance is of secondary importance to them. That's great. There's products that fit that. There's other people that are the total opposite. They don't care what they have to pay. They're looking for good performance. And so that's the beauty of this job is we can do that. It doesn't matter what the client wants. We can do it for them, and we can educate them about the options that they have, and then the costs that are associated with it. And most of the time, if people see the value that you're bringing to the table, not only in building these portfolios and helping people save for whatever goal they've got, but if people see that you're taking the time to educate them about why you're doing what you're doing, people value that. People realize that, okay, not only is he doing his job, but he's actually talking to me about what he's doing and why he's doing it. Whether they care or not, because a lot of people, they don't really care, right? It doesn't really matter, though, because they see that you're putting in that time to help them and to expand the knowledge, because ultimately that's the name of the game. The more people that are financially literate and know how to save and how to be financially responsible, the easier my job is. So why would I not want to educate as many people as I can and have them educate their families and do that? Because that just makes my job easier. It makes it so that people come in already with that baseline of knowledge, and they're just looking for that professional guidance to get them the rest of the way. Yeah. Instead of starting at ground zero where they've never heard of a checking account before, right? Like people don't know. The vast majority of people just don't know much, which is crazy. In a lot of ways, it's also sad.
Yeah.
Right? Like, so that's one of my goals, is to just help people learn, and from there build a good business on top of it.
Yeah, that's what you're doing right now, honestly, with me and everyone listening. You're educating me.
Yeah.
All right, cool. So to kind of piggyback off of where we were going, maybe we can cover some definitions through answering this. But as far as building a retirement account or investing, how does it change for someone investing in their 20s versus when they start investing in their 50s or later on down the road?
Yeah. So if you start investing in your 20s, you're in a good place. And to be quite honest, it won't really matter what you're invested in, as long as it's quality U.S. stocks, U.S. bonds. If you start investing in that kind of material in your 20s, you will be in the top 10 percentile of retirement plans by the time you retire. And that's simply because you've spent the time in the market. That's a big thing that I try to tell my clients. It's not about timing the market; it's about time in the market. I don't really care when you get in or when you get out. That has some effect, but really the bigger effect is how long were you in. If you were only in for 6 months, chances are your account didn't do too well, in comparison to if you were in there for 6 years or 16 years or 26 years. If you look at, pick any stock you want, look back 40 years and look where it was, 40 years ago. A lot of those companies didn't exist. I mean, if you got into the ground floor of Amazon, right, when Amazon started, where would you be now, right? So although, that's not the best example for if you're just in mutual funds, it's that thought process of, oh my goodness, if I start now and I have 40 years till I retire when I'm around the age of 60, I mean, just look at how things have done the last 40 years.
Yeah.
And it's no guarantee, but, we expect the stock market to go up because we expect profits to go up because we expect our population to rise. And that's sort of the baseline of it. The more people that exist that are more buying products and inventing things, the more the economy grows.
Yeah.
And that's why we see that general positive flow. And that's the whole key. If you start in your 20s, you're in a very good position. I would say the average age of people that I work with is probably closer to 40. For people that are just getting started, around 40. And you still have time when you're 40. You can still build a solid financial plan if you're starting at 40. You can still do it. You have a lot less wiggle room. You've got to be really diligent about what you're saving every month and what you're invested into. You've got to be very focused on it. But you can still accomplish anything really that you want to accomplish that's realistic. It's once you start getting into over age 50, if that's when you're starting, it's time to buckle down, because you've lost all that time that you could have been accumulating that wealth, and now you've got to be just laser focused. Like, you can't be a dollar off your budget. You really can't, because if you want to be able to retire at 60 and you're starting when you're 50, you need to be able to save a lot of money, and you need to have a viable way to invest it in a way that's it's going to grow. And you're probably going to have to take on more risk than you'd like. It's just not ideal. So that's why I tell people, if you start when you're young, you're going to have almost no issues
And even,
as you get older.
Yeah, even with risk, you can take higher risk because it's actually less risk
Because you
over
don't
a
need to touch the
50-year
money.
period.
Yeah, like, I don't need to touch the money in my retirement account for probably 40 years. I don't care what happens to it today.
Yeah.
I couldn't care less, because it's literally going to be in there for 40 years. And so, when you're talking to someone that's older, obviously that mindset changes. You start to care more about the day-to-day. And as you start, if we're saving for retirement, for example, we start to really care about, okay, if we're 59 and we want to retire at 60, we need to make sure that we are dialed back to where we're not going to lose 30% of our portfolio the month before we retire.
Yeah.
And so that's a big piece of it is, okay, it's time to start dialing back the risk. We've made our money. It's time to hold on to it. And so the strategy changes based on your age, but absolutely when you're young, it allows you to really have a lot more flexibility. And on top of that, if you're learning how to save money and invest money when you're young, I mean, that helps you so much, like, because a lot of people live paycheck to paycheck, and the only reason they do that is because that's how they've always been. They did that in college, they did that in their 20s, their 30s, their 40s, they're still doing it in their 50s, because that's just the way it's always been. So if you can get people out of that cycle and say, hey, instead of doing that, how about we put $100 away every month? Can we do that? Oh yeah, I guess we could. Great. You start there, and then maybe next year, hey, we've been doing 100. Do you think we could do 150? Oh yeah, okay. And that's really how you start the process of getting someone in that mindset, because no one else is gonna save your money for you. Mm-hmm. In the United States, we're seeing a huge shift from employers offering pension plans, which is basically a sort of guaranteed retirement income that your employer offers you as a benefit of working there.
Yeah.
Right? We're seeing a big shift away from those types of plans because the risk is all on the employer. They've got to pay you for the rest of your retirement. And that's a big risk for the company. That's a lot of money for them. And quite honestly, companies just don't feel like doing it anymore. And so instead, they're offering, retirement plans, 401k plans, things like that. And then the risk is entirely on the employee. The employee has to put money away for that 401k to be worth a dime. If they never contribute to it, that account will be at zero when they retire. And that's why it's really important to understand that, that's the way the world is transitioning to more individual responsibility when it comes to your finances. And so for me, that's something where, again, educating people and saying, hey, look, this is going to be up to you. People have a lot of questions about how they're going to get to retirement, and that's one of the big ones is, honestly, it's up to you. Mm-hmm. Your lifestyle is going to be entirely dependent on what you've done over your 40 years of working. And that's news to a lot of people, because people know that Social Security exists, but people don't often know how much it is. And then when people realize that that's probably not enough to live the life they were living when they were working, well, now that's a newsflash. And now, maybe I need to start saving money, and that's when it's too late.
Yeah.
So that's the whole name of the game, is making sure that people know that, hey, look, it's on you to provide a future for yourself, and I'm here to help you maximize that and teach you how to do it.
Yeah, to me it's like we were talking earlier, no ceiling, no floor. I mean, you can really take advantage of making some good investments and being smart, and it can pay off, or it can, get you a seat in Walmart for the next 20 years of your retirement.
Yeah, I mean, and there's some people that they just straight up don't have the choice. They've got to, because that's just the spot that they're in. And it's about, it floats between 45 and 50% of the retired population that only has a Social Security check as their only source of income.
Jeez, that is
just
scary.
About 45 to 50% every year.
Which means they did nothing except collect a check from their employer, right?
Yeah, it means they spent their whole paycheck. They never put into a 401k. They didn't even have a pension through their employer. So all they have is the Social Security benefits that they paid into while they were working. And what I try to tell people is, let's flip that on its head. Let's treat Social Security like it's a bonus check, and let's figure out a way to provide for ourselves first.
Yeah.
If we can provide for ourselves, and then we have an extra bonus check from the government with Social Security, we're going to be having a great retirement.
Yeah.
Right? Whereas if we're living the other way around, it's likely that we're not even going to ever fully retire.
Yeah.
Or at least not be able to travel or live the life that you want to when you do end up retiring.
Yeah. So as far as investing, we were talking about the 20s versus your 50s. What are the investments you can make from low risk to high risk? If we could just run through some examples, you don't have to hit all of them, but
Yeah. So really, from a basic standpoint, if you're in mutual funds or ETFs, which are those index funds, same word for two different things. Those are going to be the low risk options because they're very well diversified. If one company goes under, you still got like 99 or more other companies that you were invested in, right? So those are generally the low risk options for actually investing in the market. Higher risk is going to be individual bonds or individual stocks. There's some bonds that companies offer. Bonds are like loans, and you're basically you're getting interest from the company. It's sort of the reverse of you're like the bank for the business, right? Which is sort of an interesting flip on things, right? But not every company is financially sound, right? So if you're the bank for a company that isn't in a good spot, well, if that company goes under, the bank might not get paid. And so there is risk that comes with holding individual bonds. And obviously there's risk that goes along with holding individual stocks. And there's different levels as well in stocks of how risky do you want to be. If it's a large company that we know a lot about, typically less risk is associated because we can see their financials, we can see if they're a healthy company, we can see if they've been growing or shrinking, hiring or laying off. We can see the position they're in. There's a lot of public information on it. As we get into smaller companies and startups, maybe overseas companies, those are all places where we don't know quite as much about it. So there's a greater deal of risk because there's a greater possibility that they're not doing as well as we might think. So within each of those classes, right, it's like a pyramid. You've got different levels of risk. And then obviously you've got more cash-based investments, things for the short term. You can have CDs, which is like a fixed rate of return at the bank most commonly. Savings accounts, people are really familiar with that. Savings accounts have a small rate of return on interest. There's other types of accounts that do well with cash, like money markets. But really, for being invested for a goal like saving for college or saving for retirement, you've got stocks, bonds, mutual funds, and index funds, and those are the big four. And figuring out how comfortable you are with each and your preferences is a big part of it, and those can change. My own personal goal is to, as I get older, start developing more of a stock portfolio for myself, just because I think it's really fun to own individual stocks. I think that's interesting. If I can own some of the local companies around here and watch them grow as I get older. And I think that's a cool piece of owning stock because you do own, you hold a physical piece of that company, and you don't get the same feeling out of a mutual fund. It's not as fun of an investment. It's sort of boring, but it does the job, right?
Yeah. As far as diversifying your investments, you talked about the big four, and as far as that goes, that seems like it's more of the market, and it's based off that. Do you ever recommend people to invest in things like real estate or other markets? And I mean, real estate kind of is a part of it in a way, like REITs and stuff like that. But buying a property and having your investment in different assets like that, how do you recommend people go about that?
Yeah, so absolutely. There's a lot of other things you can invest your money in, right? If you're a business owner, a lot of times you're investing money in your own business. That's really common. A lot of times people invest in their house, their primary residence, right? Or maybe they've got rental properties also. Maybe people have physical gold or silver. That's another way that people invest. And so there are a lot of other ways you can invest your money. And I wouldn't say that any of them are necessarily a bad way to invest your money, in all honesty. But there's definitely something to be said for not being subject to just one. If you ever have, and the phrase super common, all of your eggs in one basket, you're putting yourself out there for more risk. If you are working towards owning your own home, right, that's fantastic. I think that should be a goal for everybody to get to that point, because home equity is a big, powerful thing. In our area, it's really common for people to, buy a home somewhere down south, whether it's closer to Seattle or the Everett area. Their house appreciates in value. Now it's worth 20% more than when they bought it. And then they move north, buy a cheaper home that better fits their lifestyle, and they just made a nice lump sum of cash. Super great way to invest your money over a period of 15 to 20 years. What I tell people to stay away from, unless you're very sophisticated and it's really what you do for a living, is getting too involved in the rental market. For example, I have a friend who lives in Florida. He's got upwards of 20 or 25 rentals that he manages. And it's literally his business at this point is he manages these rentals, and when he has enough saved up, he gets another one. And that's his constant thing. He does rentals all day, every day, because he knows in the long run, rental income is just going to keep going up, and he's going to make a lot of money off of it.
Sounds pretty rock solid.
Yeah, great for him, right? But the problem is if you're just an everyday guy, you're going to work and you've got 2 or 3 rentals that are sort of taking up all of your time and all of your money, quite honestly, maybe that's not the best investment to hold if that's all you have.
Yeah.
And the big thing with that is liquidity. It's hard to get rid of a house a lot of the time. Right now it's really easy. But a lot of the time it's harder to sell a home and get out of that investment than it is to get out of a stock.
Yeah, okay.
Right? So for that reason, it's important to have both. I think having a rental home is definitely not a bad thing. But you just want to make sure that you've got other buckets involved as well. Because it just helps you out in the long run. You keep some of that risk diversified away, and you're going to up your knowledge also being involved in multiple things. That always helps too.
Mm-hmm. It seems like the biggest factor in saving is having money to save. As far as increasing your income, that's probably the biggest factor of how much you can actually save in retirement.
Yeah.
I don't know if it's the biggest because the money can grow if you were to buy Amazon when it started. You might not be in too much of a pinch. But how do you encourage people, or is it part of your job to get people to increase their income or diversify their income? What can you speak about that, having more than one income stream, and where can people do that? Is it with dividends on your end, or is it just getting a second job or asking for a raise? How do you what would you recommend for people looking to increase that?
Absolutely. So step one, when you're talking to someone that wants to start investing, right? So if we're talking about new investors, first thing we look at is, okay, what's your budget every month? What are you spending your money on? Where's the money coming in from? Oh, I've got a job and I've got a rental house. Okay, cool. Where's the money going out? Oh, I've got my mortgage. I've got to pay the mortgage on the rental. I've got grocery bill. I've got utility. And you add it up, right? And you figure out where's the money coming in, where's the money going out. Sort of some cash flow analysis, really, at its basic level. And some people know inherently, yeah, I spend about $3,000 a month and I bring in about $4,000. Okay, great. What do you do with the other $1,000? Oh, I save it up for a trip every year. Or, oh, I just leave it in the bank and it's in my checking account, or wherever. You figure out where these people are keeping their money. And if people are at the point where they're living paycheck to paycheck, okay, the solution is, okay, we either cut our spending or we make more. And for most people, the easier thing is to cut your spending. Because if you're living paycheck to paycheck, a lot of the time it's because you're spending your money in places that you don't really need to. Whether that's you go out to dinner 20 times a month instead of going to the grocery store once a week, or it's, hey, I go out and I party every Friday and Saturday night and I dump $600 every weekend. Maybe that'd be better spent if we took half that and we put it into a retirement account. Right? Let's just go out on Friday instead of Friday and Saturday, right? Something like that. And then beyond that, when we start to do this long-term planning piece, especially with younger people, it's, okay, this is your job now, but what are your goals for your job? What do you want your career to be? Is this where you want to be? Do you want to move up the ladder if you're in corporate America? Do you want to own your own business? Do you want to, what do you want to do? And then you start to learn how much, we call it upward mobility they have. And as they continue to move up in the world, whether it's of their own accord, making their own business, or they're just moving up the ladder. Now we have more things we can work with. It makes it so that we're more flexible, and absolutely, you should always be not settling for the salary that you earn. I think it's common knowledge almost at this point that you should be asking for a raise if you are doing good work. And I know a lot of people that are being asked to do even more work right now than they were 9 months ago. And absolutely ask for a raise, because if you're doing good work, the worst your employer can say is no, we don't have the money for it. Because they know that you're valuable, because they can see the work that you're doing. So there's no reason not to push the envelope.
Mm-hmm.
Just have some confidence. If you know you're doing good work, then there's no reason not to do that. So that's really where we start. We start with the budget, and then from there we sort of look at where's the money going, where's the money coming from, and that's really how we get people to start saving on that monthly basis, that systematic, almost put it out of mind. Like I've got mine set up to where I've got money leaving my bank automatically. I don't do it on a monthly basis. It just happens.
Mm-hmm.
Because I know if I have access to that money, I might spend it. So I take it out of the equation. It goes from my paycheck into my bank, and within 12 hours, it's already gone from my bank, and it's in my retirement account.
It's okay. So automating it, is there a way to automate your? Someone's here. It doesn't matter. We get also while they're going. Can you check to make sure it's good? My train of thought is off of the rails. Bringing it back. Okay.
Automating it.
Yeah, automating it. So when you take it from your checking account or savings account or whatever it goes to, can you automate, like, you want to put $5 every paycheck or $100 into a Roth IRA account and have it be invested, or do you have to go onto the account and invest it?
Yeah, so absolutely. At this point, we're able to set it up so that I can send $100 from. I get paid. I get my paycheck, right? My paycheck goes to my bank. That $100 goes straight from my bank into my Roth. From there, it gets invested into these 3 mutual funds equally.
Really?
We can set that up. We can do that for people. We do it for people. And that's the beauty of investing now, is it's become easier to do these kinds of things really than it ever has been, because we've got more technology.
Yeah.
Like, you don't have to physically take your check down to your financial advisor every week, sit down with him, do a trade, right? Like, we don't have to do it anymore. It doesn't have to be that hard. Like, it doesn't have to take that much effort. It does take foresight and planning and, coming to grips that you need to do this and that you want to do it. But other than that, like, once you get through that mental barrier of starting, being able to systematically invest has become much easier, and it's really powerful because it keeps people honest. It keeps people continuing to work towards that goal without having to figure out where the money's going to come from every month.
Yeah, I got to figure out. I don't have that set up with mine. I need to figure out how to, because I know how to automate it to the Roth, but I don't know how to get it onto like an index fund, or like, because there'll be an index fund that's like $100, but you can't buy like a fraction of that, right? Or can you?
So it depends if you're doing it yourself or if you're working with a broker. So I'm a broker dealer. As a financial advisor, that's like my actual title, broker dealer.
Oh.
And so, like, that's what I do, is I actually put in those trades. And so from my end, I can absolutely say, hey, I want 30% going into this fund, I want 30% going into that fund, and I want to buy two shares of Apple every month. I can say that. If you're doing it yourself through some of the online brokerage accounts, I don't actually have one. I don't use them because I can do it myself through my company, so why would I have another one?
Uh-huh.
I don't know on that end if you can actually systematically invest in the same way, because you're not the one making the trade.
Oh,
right?
so
You're giving the money to that third party, and then they're doing it. So they might not let you, split it up that way. They might let you put it into the Roth, and then you have to individually go in and do the trade.
Whoa. So
So
you're like the guy. Then you directly work with it, investing it yourself instead of someone who has a brokerage account with TD Ameritrade
yeah,
or M1 Finance or whatever it is.
hmm
You're that middleman.
yeah, I'm the guy that actually puts in the trades and actually sends the money where it goes, whether
Dang.
it's buying shares, whether it's paying a mutual fund company, whether it's buying index funds. Yeah, I put in those trades, and we watch for when it settles, and then we know it's in there and it's earning money.
That's awesome. How much do you recommend people save every month?
So it depends. As a younger person, just get started. Whether it's $50, $100, doesn't really matter. Find something that you can save every month that you're comfortable with, and do it. And whether when you're young, some people have better jobs than others because some people are working through school. And when I was working through school, I was working at Buffalo Wild Wings. I had maybe like $50 extra a month. Cool. Like that's the best I could do. That's fine. Like that's just your reality. Do the best you can. But really, the goal I tell most people is if you're not at a place where you've got like a career job yet, right? So you don't really have access to that 401k or anything. You do have access to the IRA. You've got a Roth or a traditional IRA. And you can put $6,000 a year into those. And so what I tell people is, hey, ultimate goal, if you can fully fund that account every year, $6,000 a year, you're doing a lot of good things. That's like first step. If you're doing that, you are really doing something good for yourself. So that comes out to $500 a month. If you're saving $500 a month, that's fantastic. You're putting yourself in a great spot. And that's once that bucket's full, then we talk about, okay, what's next step?
Yeah, because doing that at age 20, right? If you can max it out every year from 20 to 59 when you can take it out, it guarantees you basically to be a millionaire, right?
Yeah, I mean, when you do the math and you do the future value on it, yeah, it's a big deal. It's a big deal.
Which compared to the 50% of people that don't do anything except get a social security check, you have all of a sudden now you have a million, 1 point whatever it is if you start at age 18 from just maxing it out,
Yeah.
not thinking about it, like given that you have the resources to do that. But
Yeah, I mean, it's a big deal. When you talk about people that are able to put the golden rule that a lot of people hear in the workplace and things is 20%. If you save 20% of your paycheck, you're in a really good place. And I agree with that to an extent. I really try to tell people exactly where their money's going to go, though. So I give them that direction. I say, hey, look, if you are maximizing your 401k, meaning you're getting the company match that your company offers you, most do at this point. If your company matches 4%, if you're putting 4% into your 401k and you're getting that 4% match, you're doing the right thing there. If you're then maxing out your IRA, you're doing the right thing there. Those are the things that you actually have to do. So instead of just saying, yeah, save 20% of your salary, actually tell them what that looks like.
Mm-hmm.
Like describe what that means. Because that's like the missing link for a lot of folks. Because they know, oh yeah, I'm supposed to save, but this month I just didn't have enough because I went to Vegas and had a great weekend. Okay, great. But now we got to get back on track.
Mm-hmm.
So it's like, that's filling in the gaps that people don't learn about because it's not taught in school. Really, most employers don't do a good job of educating their employees because they really don't have much of an incentive to.
Mm-hmm.
They really don't. They know that if they offer a good program, if they offer a good 401k plan, that's an incentive for people to want to work there. But if you tell someone, oh yeah, we have a great 401k plan, the average person is going to go, oh, great. They have no idea what that means.
Yeah.
Their 401k plan could be terrible. They would never know.
Yeah.
So there's really not a huge incentive for the companies to do much education. And obviously, if you're not receiving it through school, where do you get it from? So that's filling in those missing pieces is the key to my job and really helping people achieve those types of goals.
Yeah, I think if someone watches what we've talked about from start to finish, that can make a huge impact on this, even just the fundamental stuff, like research everything he said, because there's some gold there as far as like getting started investing, just as far as what you talked about with bonds and index funds and risk and moving that on to saving and diversifying and all that. There's some really good stuff. Kind of going on the more of the personal characteristics of a person of somebody looking to invest or in a financial headspace. What is the most important human characteristic that you have noticed to becoming financially successful? Is it like discipline or just being positive or along those lines? Or what do you
I
think?
would say the number one, like for the clients that I work with, the number one thing that I see being of benefit is being coachable.
Hmm.
Because ultimately, that is my job.
Yeah.
Like, I'm an advisor.
Mm-hmm.
Ultimately, it's my job to literally coach people how to save their money, how to invest their money. And so the people that take the advice and that realize that they don't know everything, because we each have a different role in our job, right? I don't pretend to know like I can fly a plane.
Yeah.
I would never assume that I could do that, right? I don't assume that I know how to clean my own teeth. That's why I go to the dentist. So if you go to your financial advisor and you assume that you know just as much as your financial advisor, it's ridiculous, right? So we each have a different role to play. And so knowing that if you're coachable and if you can accept that, yes, okay, this person knows what they're doing, they've been educated, trained, licensed, their knowledge is helping me, that's the number one piece, because a lot of people are dead set on doing it themselves for cost reasons or just because they feel like they know how to do it. And that's great. What I tell people in my first meeting with folks is I say, hey, look, if you have the time, the knowledge, and the desire to invest your money yourself, by all means, do it yourself. Right? If you've got all those three things, why would you not do it yourself? If you like doing it, if you know how to do it, and if you have the time to do it, you should do it yourself. If you're missing one of those things, that's where I come in. And so being able to be coachable and being able to understand that there are tools and knowledge out there that you don't have yet, no fault of your own, you weren't trained in it, but that I have, that's how people have success, because they learn things that they would have never learned doing it themselves, for the vast majority of folks.
Yeah. And I mean, when people think of getting a financial advisor, the first thing that comes into their mind, I mean, I don't know if it's the first thing, but I'm sure a thought is, oh, I don't want to spend the money on a financial advisor who's not very interested. But I guess what I'm getting from this is you're losing money by not getting the advisor, or I mean, more specifically you. Like, it's hurting you more to not do anything with your money than it would be to have someone who knows tenfold more than you on what the investing and how to do it, because you're going to make more than you ended up. It's a fraction.
Yeah, and what I tell people, again, in the first meeting, I set it up with that. I say, if you want to do it yourself, listen, that it's a viable way to invest your money. People do it every day. There's lots of platforms to do it. If you've got those three characteristics, why not do it yourself? And then I tell them, if you don't want to do it yourself, here are the other ways it's possible to invest your money. And some of them I'm able to help them with, and some of them I'm not. And I line it up from cheapest to most expensive. And the most expensive way you can invest your money is by doing nothing with it and leaving it in the bank. And so many people don't realize that. They've got their $50,000 in the bank, and they don't even realize that money is dead. It's sitting there. It's not doing anything for them. It's not working towards any goal. If that money is, if you're saving for retirement by putting your money into your checking account, it's just a huge mistake, no matter how much it is. But people don't know, because, in high school, what were we taught? Oh, yeah, you've got a checking account, you've got a savings account, you're good to go.
If you even get that in high
If you
school.
even get that, right? And maybe you hear it through a friend. And that's all you know. So, if you're saving for retirement through a checking account or a savings account, you're probably never going to get there unless you're making an insane amount of money.
You're losing money because the inflation at 3%.
Exactly. And that's what I tell people. I say, look, There's lots of ways to invest, but just know that you gotta do something other than sit on the sidelines. And there's ways to do it appropriately. Not every investment fits every person, and there's lots of ways to go about doing it. Just know that you can't sit on the sidelines for years and not do anything about it.
What is a book you recommend?
So, not one specific book, but a place people can go to get more knowledge. Anything that you find, well, I mean, he does have books. Dave Ramsey. Anything by him is great for people that want to learn. He does a great job of teaching people how to be responsible with their money. Because step one, before you can even invest your money, you've got to be responsible with it, right? And so he really is great about teaching people how to be responsible. And his big thing is cash for everything, right?
Yeah.
No credit cards, no debt. Like the only time you should ever have carry any sort of interest rate is on a house. That's his big thing. And the truth of the matter is the reason why he tells people that is because it's smart. It's because people get into credit card debt more often than they don't.
Yeah, he's kind of saying that, expecting people to not be responsible with a credit card.
Exactly. So, I have a credit card. I don't tell people to not have a credit card. But the idea remains the same. Even though I have a credit card, I don't carry a balance on it. It gets back to zero every month. I've never paid a dime of interest on my credit card.
Yeah.
But to a lot of people, that's news. That's what? Why don't you do that? I don't understand. And so his website and some of the books that he's written are a great starting point for learning how to be responsible with your money. Because the truth is, if you're saddled with debt, which a lot of people are, you can't invest. Because when you're paying, if you're holding a personal line of credit that's got an 18% interest rate, you're going to be hard pressed to find an investment that's going to earn you 18%.
Right. You're better off paying that off before you invest.
Yeah. So anything by him, he's got a website, he's got books that he's written. Just by looking through his website, you can find a lot of good free resources, PDFs explaining different things. And that's a great place for people to start to learn about, how to be a little bit more responsible with their money. And then from there, there's all sorts of spin-offs and things that he does and classes that he teaches. But really, just getting a basic understanding is definitely important.
Yeah. I don't know if being a financial advisor, if this would work for you if you're giving away free stuff, but you know a lot and you can articulate it really well. I would share it with the world if you started a podcast. Like I listen to a lot of financial podcasts, like the Personal Finance Podcast. I'm trying to get a hold of the guy to interview him, but he won't get back to my DMs. But there's another one, Financial Freedom. Grant Sabatier. They take topics and they just break it down. Dude, I would listen to every single episode 100 times if you started a podcast. So I'm just
one thing that I've tried to do with some of the people that I've been in regular contact with and some of my clients is teaching financial classes.
Oh yeah, I went to one.
Yeah, and you were on one, and I try to cover some of the most important fundamentals, really, because honestly, that's the most important part. If you've got that underlying understanding and knowledge, from there, everything else is details. But just knowing a lot, like that, these different things, knowing that a Roth IRA exists. What is it? What does it do? Why would I want one? Learning those types of things is crucial to having a successful retirement, having a successful financial life, and really for me, what I tell people and my own thought on things is, like, financial success is what you make of it. So, like, for me, when I retire, I want to be in a place where I don't ever have to worry about the money that's in my bank account. Like, money is not something that controls my life, basically. I'm not going to be someone that's going crazy, going down to Vegas or going down to the casino every week. But I just want to be in a place where it's not something that's even a part of my life. It doesn't need to be something that controls me. And that's my goal for myself. And so I tell people, find your goal that you want down the road, whatever that looks like. And then that's really what we're trying to achieve. And oftentimes it doesn't even need to have a numerical number associated with it. Like, I don't have a certain amount that I know I need to have to never worry about money, but I know what the feeling will be.
Yeah.
And so I'm pursuing to achieve that feeling.
That's awesome.
And so that's my own philosophy, and that's what I tell people. I'm like, look, have a goal. Whatever your goal is, that's what we're trying to achieve. It's less about the actual numbers and more about what you want. Because the numbers change, right, all the time. But figuring out what you want and how we can get you there, that's the whole.
I love it.
That's the whole part of the puzzle right there.
And then to kind of wrap things up, I always like to ask, what's your definition of wealth?
Yeah. So for me, wealth is success. And not just success in terms of money, but success in terms of the way that you live. So when I think of someone that has wealth, I think of someone that they've got a fantastic family, they've got a fantastic support system around them of friends and coworkers, and they've built a life that they can be proud of. And that's success and that's wealth. Because if you've done those things, the money comes. And that's just the plain truth of it. If you're that type of person, the money, the number of your wealth will show. Because those are the types of people that find success, are the good people that have a good family, that have a good relationship with their community, that give back, that volunteer. Those are the people that I want to be associated with. That's the kind of person that I want to be. And that's wealth. That's having it all.
Yeah, I couldn't have said it better. Where could people find you if they want to hire you as a financial advisor?
Yeah.
Do they need to talk to your agent first? Are you too high profile? Do you only work with billionaires? How can people find you on Instagram? Where do you go?
Yeah, so I do not have like a minimum amount of money you have to be a client of mine. I'll talk with anyone, in all honesty. I don't care if you don't have a dime to invest with me. I'll give you the time of day. I'll talk with anyone. My office, I have a physical office. It's south of Snohomish, close to Glacier Peak High School. I've got a website, Ryley Nelson at EdwardJones.com. We can throw the links and stuff, I'm sure, on this. I've got a website. I've got a LinkedIn. Just search Ryley Nelson, Ryley. Got the funny spelling in there. And yeah, you can find my office number on there. And obviously, if you're someone that's listening that's already got my cell phone, yeah, reach out. I'd love to have a conversation. It doesn't cost anything to talk to me. Every time I talk with people, there's no charge. I'm really out to meet people, to help them figure out their own situation, and that's step one. So, yeah.
It's awesome. Ryley Nelson, everybody. Thanks for coming on.
Thank you.
Appreciate it. Get wealthy.